Hello friends, welcome. Friends, today we are going to do a very interesting discussion, and therefore I will like to encourage you to watch this video till the end, and I am going to assure you that you are not going to repent this your investment of this time. Now, before I take you through this topic, which is right in front of your screen, I would like to make a very important point. If anyone wants to understand a subject which is data centric, you need to have the ability to process and visualize data by yourself. Please learn that art. Without that, it becomes very difficult to understand a particular subject, because everything today is data centric. And I have been trying my level best to learn it, and I have been spending a lot of time, and it is giving me huge amount of dividend. And you will see the analysis that I have put together and what kind of insight it is able to draw. So friends, the topic is very simple. Why do currency appreciate or depreciate against US dollar? Right? So the fundamental point here is that everybody will say that it's very simple. It's a demand and supply equation. So if you look at this chart, it's a demand and supply equation. What is demand and supply? If the demand of US dollar increases versus the local currency here, right? So then what will happen? The currency is going to, so this is the local currency and this is the US dollar. So if the demand for US dollar increases versus local currency, the US dollar value will increase and the currency will depreciate, right? And if the demand for currency increases, the local currency increases versus US dollar, the currency will appreciate and the US dollar will depreciate. But why? Why the demand for local currency will increase versus US dollar or vice versa? It is simple flow of foreign currency across border. Now, if there is an inflow of dollars inside the territory of a country versus outflow of dollar, then what will happen? The demand for local currency will increase because the dollar has to be exchanged to local currency to make investment within the country, right? So the demand, so currency will appreciate. But if the dollar flows out, then what happens? And for making investment in US or any other market, then what will happen? The demand for dollar will increase, right? And therefore the dollar will appreciate and the local currency will depreciate. Now, to understand why the cross-border flow of funds happen, what is the primary reason for that, I started investigating this issue. So what I did, I first looked at the balance of payment situation. So let's look at the balance of payment situation, and that balance of payment, how the balance of payment does the balance of payment gives us an insight whether we can make an clear-cut conclusion that the demand for dollar has increased or decreased. So I started looking at it, the balance of payment situation. So what I saw Japan, China, and Germany. Germany, Japan, and China in first three in this table from the point of view of positive trade surplus. This is basically a current account surplus. So Germany had a current account surplus in CY 2004 of 117.7 billion US dollar. Japan has 85.5 billion US dollar and China has a 71.7 billion US dollar. But strangely, I found the Japanese yen has depreciated by 34.9% in Q4 FY24, right, versus US dollar. And when I see US as a country, they have a trade deficit and their currency is stronger and the Japanese currency is weaker. So you will find this across all the countries, right? If you take Korea also, and I don't know where is Korea here. It must be somewhere here. I don't want to waste my time because when I do video, I don't do editing. So therefore, let's leave it. So look at any country and you can pause this video and have a look. For example, let's look at India. India has a trade deficit of $15.8 billion and Indian currency is also depreciating. Okay, so this does not give us any correlation, right? So what I did was I looked at another set of data which is called the tick data. So let's look at the tick data. Tick data is what? Treasury International Capital data, which kind of shows us an ability to measure the outflow and inflow of funds within US. So this table 2 is the foreign long-term security held by US resident, and table 1 is the US long-term securities held by foreign resident. Means foreign residents are actually making investment into US, and here the US is making investment into foreign countries. So I looked at Japan. So when I look at Japan, I find that the foreign long-term securities held by US resident means US resident investment in Japan has been increasing on a monthly basis. Similarly, I found that the foreign residents means Japanese investment in US has been also increasing. Though this investment, this value is higher than this value, but it still not gives us a very clear picture because both are in increasing trend. It really does not give us any kind of to draw any conclusion whether a currency is going to depreciate or appreciate, right? Then I looked at another table, which is called the table is called the US Treasury Table 3, right? So this table is giving us the complete picture of the US Treasury long and short term both held by foreigners. So Japan Japanese have been holding US securities, and I found that the securities that are being held by Japan is kind of reasonably at a stable rate. So though in CY24, if I look at CY24, if I see that it is $1.168 billion, and this number hasn't really significantly changed compared to past years. So this also does not give us any kind of clue whether the Japanese currency should appreciate or depreciate, but it kind of points to the fact that Japanese have been investing in US significantly, and even in years when the currency has appreciated. So I did an experiment, and when I did this experiment, I came out with some conclusion. So this conclusion I'll explain at the end of this video, and you can clearly read this conclusion before you go through this experiment. And this experiment is going to be very, very important, right? So what is this conclusion? The conclusion is that the main conclusion is this: rate differential. This is the key conclusion. So you will find the policy rate, which is being determined by or driven by central bank, like US central bank Fed will set a policy rate for US. Indian central bank or Japanese central bank will set a policy rate for Japan or India. If the differential rate between these policies increases, the gap increases, then what will happen is the currency will appreciate. And if the gap decreases, the currency will depreciate. And you will see clearly coming out from the chart. Now, why this happens? It is very simple. If Indian policy rates are set very high and the US policy rates are set very low, then bond yields, at least the short-term bond yields in the US market, is going to give less returns compared to bond yields in India. Therefore, from US, the investments will start pouring into India, provided India doesn't have a very high inflation, right? So that what will happen is that demand for Indian currency is going to increase, so Indian currency will appreciate. And if the reverse happens, the US currency is going to appreciate. So therefore, you will come to this conclusion that the rate change decision by RBI is not independently driven by inflation. If they really want to contain the value of rupee, it is driven by the US fund rate also. So you can't really say that RBI is going to independently decide to cut rates. When people talk about RBI cutting rate, it will never happen like that unless the US cuts rate and brings their interest rates below a certain level. And I'll show you through this experiment, and you will find this very interesting. So what I will do, I'll first, I will basically, this chart is a comparison of policy rates, currency rates and inflation rates between two selected countries. So I will have US always selected, and I will choose one of the currency rates, and I will see the trend of the curve as we move from one time to another historically, right? So let's pick up India first. So let's look India, because I am more interested in India than any other country, right? So I'll pick India. So when I pick India, I now start comparing Indian policy rate versus US policy rate and see how Indian currency has moved against US dollar. That is the main point here to discuss. So I find that at the initial stages, right, if you look at the in year 2000, India held the policy rate pretty high, and at that time the US started decreasing their rates. See, you can see here, the India policy rate was 8.75 and the US started bringing down the policy rate. So at that time you will find that our rupee actually started appreciating. You see, it was held stable, it depreciated a little bit, and then it basically went down because the gap increased. Did I tell you that in the beginning? The gap between the US policy rate and the Indian policy rate increased. So you find the rupee actually appreciated. Right? And it kept on appreciating, and then what happened was the US started bringing their rate higher. This may not be absolutely synchronous, there may be a phase lag, but this follows. If you pause the video and look at this, you will find that it kind of, most of the time it will actually be applicable. For example, if you see here, let's look at this. India has been bringing down their interest rates, right? From 30th November 2014, it was bringing down the interest rates. The US actually had the interest rate at stable 0.13%, and then they started increasing their interest rate. Then you will find that the Indian rupee also started depreciating. So it moved down because there are certain intervention which RBI will do. There will be some kind of shocks in the system, in the economy, which the artificially also sometimes people started managing. But in the end, you will find that this is applicable. You can select any other country. Now look at this particular situation. The policy rate of India was set at 4%. The US also brought down the policy rate to 0.13%. So at that time, you will find that Indian currency was held stable. See, because this gap actually was maintained at a constant level. So if it is constant, the currency also is held stable, unless and until RBI or any other factor impacts, right? And then as the US started increasing their policy rate, India also simultaneously started increasing the policy rate, and US policy rates were held static. India also held their policy rate static, and you will find the rupee was reasonably stable, and there have been some minor variation here and there. So largely this is true. So let's look at another currency. Let's look at Brazil, right? Let's look at Brazil. So I'll choose Brazil here, and let's look at what happened to Brazilian currency. Now Brazilian currency, the Brazilian interest rates were held very high at the initial stages at 2000 at 19%. The US was at 5.5%, 5.5%. So if you look at here, the gap actually reduced, right, in this period. So you see, the currency started depreciating. What did I tell you? If the gap is high, the currency will appreciate. If the gap is on decreasing trend, the currency will depreciate. So it started depreciating. Then what happened was the gap increased here. You see? So the currency actually remained stable. So there was the gap here became almost very, very high. So look, the currency appreciated. Then in this period, the gap actually was high, but it remained stable. The currency also remained stable. Then what happened was the gap actually started reducing. See, here the gap started reducing. So when the gap started reducing, the currency also started appreciating. So it kept on appreciating because the gap became very, very small here. The currency appreciated, and then what happened was that the Brazil probably had an endeavor to contain inflation, because the inflation became very high. So they increased their policy rates. When they increased their policy rate and the US decreased the policy rate, at that time you see the gap actually increased much beyond what the gap was here. So what happened was it became the currency, basically there was a slight kink here. I really don't know why, but the currency basically remained stable because there was no incentive for Brazilian to make investment in US. Because of why? Because the US interest rates were held very, very low, and Brazil more or less maintained a stable policy rate at that time. So interest rates were held low, and you will find that the currency more or less remained stable, right? And then currency depreciated wise when the US also started increasing their interest rates. Right? You see, US started increasing their interest rates. At that time, there was a slight dip, and then the currency started depreciating. You see here, the Brazilian was started bringing down the interest rate. The gap became low. Once the gap became low, the currency basically started depreciating. And the same situation happened here. There was a slight fluctuation here like that, and then what Brazil did, they increased their policy rate significantly compared to what US did, and therefore the currency appreciated, right? You can very clearly see the direction of the slope of this curve. So you can choose any country, right? Any country you can choose, anyone. Let's choose Mexico and see what happened to Mexico, right? You will find the trend is almost similar for every country, right? Here you will see the same thing happened, right? When the gap is maintained and the US basically maintained a policy rate of very low percent, the currency remains stable. The Mexican currency remains stable. As soon as there is a reduction in the gap and US started raising rate, the currency started depreciating, right? And here also the same thing is true, right? You see that they have raised, Mexico has raised their policy rate significantly, and therefore compared to US, therefore the currency appreciated. So my point is this experiment you can do with any country, whatever country you choose, you will get a similar result. You will find that the result is almost, so at the end of the day, what I want to say is that the interest rates of a particular country, the decision of the central bank of a particular country is not independent. It is not solely driven by inflation. It is driven by the reason to maintain, the urge to maintain the stability of the currency, and it has got a huge amount of impact on the US policy rates. This is clearly evident from this chart. So, friends, after doing this experiment, I figured out that it is very easy to even make some prediction. See, it may not be 100% true at all the time, because there are some artificial intervention which happens by the central bank when they start artificially buying and selling US dollars. At that time, the currency may fluctuate in either direction, right? But most of the time, you will find this is true. So I hope that, friends, you found this video very interesting, and to basically conclude, and so that it's very clear now. So what do we conclude in this video? The currency fluctuates. So let me just put my pen here. The currency fluctuates against US dollar as the investment in US bond become more appealing. And that will happen only if the US interest rates are higher or actually at par with the interest rates of a particular country, and the gap actually becomes smaller. Central bank influence. The policy rate set by central banks directly affects the yield of short-term bonds. That we all know, right? I have done many videos on this. The rate differential and appreciation. As the policy rate gap widens between a country and the US, the country's currency tends to appreciate. And the depreciation, conversely, as the policy rates narrows, the country's currency likely to depreciate. Right? So it appreciates here and it is depreciates here. So policy rate decision, the decision on policy rates in a specific country are heavily influenced by US rates set by Federal Reserve, reflecting a broader consideration beyond just inflation or liquidity. So friends, I hope that you like this video. You share this video on whatever you found. If you have any comments, let me know, because I am also learning in the whole process, and hope that you will make some comments, and then let me know that if you need any other topic to cover in near future, and I'll be very happy to do that. Thanks a lot for listening, and I'll come back to you with a new video next time. Thank you very much.